Welcome. What we're talking about today is the 7 metrics of trading edge. And this is how to know, truly know your trading edge. If you have one, how it works, and what to really expect from your edge from day to day. So what we'll cover in this video is what is a trading edge, and we'll talk about the 7 key metrics to measure and fully understand and know your edge in trading. And this is for absolutely every style of trader. Day trading, swing trading, position trading, fundamental, technical, automated, anything you can think of. These metrics absolutely apply to all styles of trading. Stocks, futures, options, currencies, crypto, whatever you can think of. All right? And also in this, I'm going to tell you how to get a printout of these slides so that you can remember what we've talked about, remember these metrics, and review them because they're very, very important. Now, I'm going to throw a lot of information at you today. So what I'd like you to do is just at least aim for one significant piece of information that you can write down and really take away from this. If you try to take away all of it, it may be a little too much, but there may be something that stands out as an important piece of information that will help you make a major change today. All right, so first we're going to talk about what is a trading edge. And for most people, edge is just a concept. It's a concept like the word love is a concept and justice is a concept. You can look up definitions and you can see examples and you can point to things, but it's not very clear exactly what it means. And it's very challenging to work in trading and only go after concepts. We need something more concrete than that. And they think they have an edge because they feel like they do. Or they really, really believe strongly that they do, that their view of the markets is correct and has an edge. And they've worked very hard to get one, to get their edge. And so because of this effort and this deep belief and this feeling that they have understood how things work, they proceed with this concept of having an edge, but they really actually are just struggling because they don't have an edge. So if your idea of an edge is linked to feelings and belief and the amount of effort you've put in, then your confidence in your edge will rise and fall based on those things. As your feelings get hurt because the market gives you negative feedback, as your belief becomes diminished because you're not seeing the results of your edge, or you see a little evidence because you have a good day or your positions move in the right direction, or you just work a little bit harder and so you kind of build that back up, your confidence in that quote-unquote edge is going to rise and fall in a very uncomfortable way. And it's no wonder traders feel like they're on a roller coaster as they try to navigate the markets. We need to get off the roller coaster and do things a different way. And that's why we prefer to define edge using numbers and statistics instead of feelings. All right? By the way, my name is Andrew Falde. I'm glad to have you here and present this to you. I'm a professional trader. I've been doing this since 2010. I've traded for hedge funds and prop firms, and I've done a lot of training and consulting for traders. We have a lot of great information in this video today, lots of different slides, and you're going to be able to get all of those. So just stick around. Even if we're into something that you think is a little bit basic or you're not really sure what's going on, we're going to cover so many different things that you are going to find something valuable to take away from this. I've worked with brand new traders and I've worked with 7-figure earners who have all taken away valuable information from these 7 key metrics I'm going to share with you. All right, so first to answer the question, what really is, if it's not about feelings and emotions and beliefs, what is a trading edge? An edge is the expected gains, losses, and net profit from a particular activity in the markets. All right? That's the way we define it. That's the way we describe it. Expected gains, losses, and net profit. So note in that definition, we are not just looking at the bottom line profit alone, but the ups and downs that are experienced on the way. So it's one thing to just have a profit, but at what cost did you get that profit? All right. And that's because as you move through in trading and you execute an edge consistently, sometimes a great edge will lose money. Isn't that a surprise? You know that's true. But we cannot allow a short-term loss or a short-term series of poor results to distract us and pull us away from a very good edge. If we can define it with the numbers and statistics of the edge, we can even look at losses with confidence because we can see how they fit exactly what was expected. Very different feeling than being on a roller coaster. Losing money obviously does not feel good. And that's why we don't use our feelings about recent results to dictate the next action we will take. Have you done that? Have you allowed a very good short-term result to make you be more confident and take a bigger size or take more trades or do something that you wouldn't have done if you didn't just have a great result or a great short-term result? Have you allowed losses or a poor trade or a mistake to change what you do the next day? That kind of short-term cause and effect is going to keep you on the roller coaster. If you want to get off the roller coaster and be consistent with executing edge, you have to have the big picture of the numbers and statistics rather than the short-term emotions of the short-term results. So if you want to trade with a profitable edge, then you need to consistently take trades with edge, even if the recent results were negative. That is like the most obvious statement in the world, right? But if you don't feel like you're actually executing that statement every single day, then you have some work to do on a very basic thing. That's the great news. If that's the only thing you really need to accomplish right now, then you can go forget about a lot of the other stuff that's distracting you that may be more complicated or more daunting. If you want to trade with profitable edge, then you just need to consistently take trades with edge, even when the results are negative. All right, quiz time. What is a trading edge? Is it A, the skill of predicting what will happen next and being right more often than you are wrong? Sounds familiar though, right? Or is it the expected gains, losses, and net profit from a particular activity in the markets? All right, we know it's B. I just told you that. You've been paying attention, right? But I like to throw out that A because that's what so many traders feel like and believe that a trading is. That they can see the markets, interpret what's going on, understand, get positioned in the right way, be right more often than wrong to turn out a profit. They have an edge. Not right. Okay? That's not right. Now here are the 7 key metrics of edge. And the metrics are given in order of importance. All right, I've been working on these metrics now for 7 years. Multiple times I have attempted to change them and I just keep coming back to the original. And all I've done as far as changing them or modifying or updating this is to more clearly and succinctly explain each of these. So the order of importance, the items included have not changed, as even though my trading style has changed, as I've evolved and improved over the years, these metrics have remained. All right, so these metrics are given exactly in the order of importance. In fact, the definition of edge is known by the second metric. If you have the first 2, then you have a very strong understanding of your edge that most traders will never have because they don't put in a tiny amount of effort to understand those 2 metrics and define whether or not they have an edge. So all you need are the first 2 to know if you have an edge. And the rest are about knowing your edge. All right, what does that mean? Knowing your edge. Identifying an activity as profitable is like being acquainted with it. Just because you know that a certain activity, when I say an activity, that means a strategy or a technique. So like a market maker, they don't have a strategy, they just have an activity in the market that has an edge. They have an expected profit and they understand everything about that. An investor has an activity. They take part as a participant in the market in a certain way. That's their activity. A swing trader, a day trader, a mean reversion, an options trader, an arbitrage trader, it's all activities. And they have the opportunity for you to put together the way you do it to have an edge, a defined edge, all right? But if all you know is that it's profitable, all you do is get to number 2 in our list of 7 items, and you know that it's profitable and has an edge, you're just acquainted with it. You don't really understand it. All right? Let me explain that. Knowing your edge, truly knowing it, going deeper, knowing all 7 of these metrics means it's like you're in the trenches and you know what it's like to really live day to day, trade to trade, month to month with your edge. And that's very important for your expectations. It's like growing from having an acquaintanceship with an edge or with a friend or with a person to an intimate relationship. When you have an intimate relationship with a person, then you kind of know what to expect day to day. You know what ups look like. You know what downs look like. You know what a rough day. You understand very quickly and easily, because of a long-term intimate relationship with a person, what they're feeling right now, what's going on right now, and how you need to deal with it, how you need to relate to that, how you need to react or take care of them in that moment. Same thing with your edge. When things are going poorly, if you understand everything about it, you know if everything's just fine and you need to proceed as planned, or you know if things aren't fine and you need to take a different course of action. You know when things are super great, how to let that play out, how to get the full benefit of that and not allow yourself to be swung too much by the fact that the very next day or the next week or month may turn around and be a loss. You know to expect that. You know the ups and downs because you know how it looks. You know what the market's going to do when things aren't working. So when that happens and you don't have a profit, you know why. When you have a large profit and you know that this type of strategy or activity can make even more, you can develop the patience to really let that work. Just knowing something's profitable won't allow you to stick with it through everything that is to be expected. We're going to repeat that and make that very clear here in a minute. All right. Metric number 1. This is absolutely number 1, the top, more important than all of the other metrics in our 7 metrics of edge. And that is risk. To truly know and understand risk. It's the first of our metrics and most important, because if you get this wrong, a strategy with edge, even a strong edge, even one of the best edges you'll ever find in your life, a strategy with edge can bankrupt you. It can blow up your account, ruin your trading career, cost you a tremendous amount of money because you got the first metric wrong. You didn't really understand the risk, so you approached the edge incorrectly and got hurt by it rather than rewarded by it. I cover this a lot, especially in the first 2 chapters of the book, Skip the Dip. If you want to look that up, look up Skip the Dip and put my name next to it just so you don't run into some other topic that's also similarly titled. But that's on Amazon. You can find it other places too. Skip the Dip, talk about that, give stories and examples of that. Risk is not just a stop loss. It's many different things, and that's where you got to dive in. To truly understand metric, you may take several metrics about defining one of these things. So risk is your maximum risk, so the absolute worst case, catastrophic, even unreasonable to expect, but could be defined, has to be defined, maximum risk, to truly understand what that is. All right. For example, to sell something short, to sell an equity short, carries an unlimited risk. If you don't truly define that and understand that, then you can walk into a very big problem. All right. Historic realized risk is another one. So that's where you've never seen, or there's been no examples of that max risk ever happening. But what is the worst case scenario that has happened any time prior to now? Many will ignore that. They'll only go look at the last 6 months of examples, the last year, or last 3 examples, or the 2 examples they saw in the YouTube video and think they understand the edge. Go find where it's had the absolute worst case scenario. All right. We also call this drawdown. All right. A drawdown is not just a single trade, but it's actually a series of trades. If a series of events leads to where the losses outweigh the winners, Sometimes that overall drawdown, the series of trades, will lose more than any individual loss had. You need to understand how the series of trades can draw down, cause losses, in order to navigate that and expect that, so that you can go through it and get out the other side and move on to profits. But if you didn't understand what drawdown to expect, and then you get into a drawdown and you just think it's broken and never going to turn around again, then you will book a loss from that activity. You will book a loss from that strategy, and you will never get back on track, and you will never get the result from all that work and that time that you put in and that risk that you put into that edge, because you didn't know it. You didn't understand it. All right? And not knowing or defining the appropriate amount of risk is, in my opinion, the single biggest mistake traders make, because they can do everything else right, but if they get this wrong, they can experience too much of a loss for what they can handle in a very good strategy, get blown out, get scared away from being profitable. All right? Knowing this is absolutely number one and the most important. Metric number two is the much more fun one. But once you get number one down, you can get on to number two and have that very vital and important piece of information about the returns. What is the return on that risk that you've taken? This is the one that defines if you have an edge, because it's very, very simple. An edge just means profits. The whole ethereal concept of edge and predicting and interpreting and being ahead of the competition or anything like that is not needed. It's very simple to know if you have an edge. It's whether or not you expect to have profits, because you have evidence of profits with numbers and statistics. All right, we'll talk more about that in a second. If you don't have a proven edge, if you don't have a positive return, either from theory or reality, then you don't have an edge. If you don't have a proven edge, then the only job you have is to get one. All right? And hint, trial and error with real money is absolutely the wrong way to find an edge. Many people think that's just the way to do it. You just got to hop in there and start trading and you'll figure it out. Two things will happen. You'll either spend too much time finding an edge or too much money finding an edge. There's no reason to go that path. I do agree you can learn from that, but it's going to be a very long and painful learning process. Okay? You're much better off defining it with numbers and statistics by study and then application. All right? Here's the reason why. Every single hour in the real world takes exactly 1 hour. It takes 60 minutes, okay? Captain Obvious, right? But if you look back and you research and you study what has already happened, an hour takes you 3 seconds. A day takes you 3 seconds. A year can take you 10 seconds to look through visually and see. You can use Excel worksheets, you can write code, and you can study decades on hundreds of symbols in minutes. Why go through 1 hour every hour moving forward with trial and error on one idea at a time, when you can take seconds and minutes to study dozens, if not hundreds, if not thousands of examples of various ideas to define if there's a positive expected return from that activity, from that strategy? You can see where I'm leaning toward. I would rather do the rapid study than take that evidence, then move it into the hour by hour real world to continue to prove it. Much better way to go. Okay? If it's profitable and you can prove it, then congratulations, you have an edge. That's all it takes. If it's profitable, and it's not just because you think it's profitable or you can look at the chart and really believe that it's profitable because it looks like it would have been profitable if you had done that. If you can prove it by running it straight through unfiltered examples, either historically or in the real world, you have an edge if you ended profitable. It's that simple. If it's not profitable or you can't prove it, Okay, if you think it is and you saw some examples where it would have been, but you can't prove it because you haven't actually run through from beginning to end, running that example, running that activity, then you don't yet have an edge. All right? I repeat, just for sake of absolute getting this straight, if you don't have a proven edge, then the only job you have is to get one. And the approach I would recommend for you is to look back first, because you can rapidly study decades of information very quickly, either visually or spreadsheets or code, any way you want to do it. You can print things out and draw on them. It doesn't matter what you do. You can get through decades of information, hundreds and thousands of examples in an absolute fraction of the time to find out the numbers and statistics of an edge that you can move forward in the real world to prove. So for absolute clarity, let's pause for a second. If you have 10, 20, 100, or 500 examples and the results are profitable, then you have an edge. If you have 0 examples, then you don't have an edge at all. You just have an idea. And I would even propose to you that if you have somewhere between 0 and 10, you still just have an idea with a little tiny bit of evidence. If you can point at 1, 2, or 3 examples, you have an idea. You even have some evidence, but you need to gather more proof that when you run that over and over, when you take that setup, when you take that trade, when you take that approach, when you use that filter, whatever it is, whatever that activity is that you believe has edge or could have edge, when you run it many times, dozens if not hundreds of times, and you see the net profit is positive, then you have an edge. The more you have, the more examples you have, the better. Okay? Bonus here that I want to explain to you. If you say, well, the 10 and 500 are very different. This is the way I would prefer to think about it. I do prefer to think about it and suggest for you. The number of years you cover is far more important than the number of examples. And that's because some strategies may execute on average once every couple of weeks. And some strategies may execute 10 times a day. And only getting a day worth of information with 10 examples is not the same as getting a few months of information with also 10 examples. That's because one day can be very bullish. You just pick one day and get one example, one set of examples from that one day that just happened to be one way of the market moving, then you'll get a false sense of security about how that works. But if you go through months of ups and downs and you take that same approach and it comes out net profitable with bullish markets and bearish markets and quiet markets and volatile markets and everything in between, and you come out with a profit, you have better information. So I prefer to look at calendar time. How much calendar time have you covered? Not necessarily the number, the raw number of examples. So if you can cover a few months, you've got some strong evidence. If you can cover a full year, then you've got a defined edge there. But I would also look at it and say, did that 1 year happen to behave one specific way more than anything else? If that's the case, go find another year where it behaved quite the opposite of that. Was it a quiet bullish year and your edge kind of makes money on the upside when things are quiet? Then go find a volatile bearish year. Go look at all the examples from that year. If those 2 years together create a positive return and an attractive positive return, now you have enough information to proceed confidently with that edge. All right, metric number 3. This is where we're going to start moving quicker because this is more filling in all the blanks. All right, the first 2 were vital, the most important. If you stop there, then you can expect to become profitable in trading. But knowing the rest of this is what's going to keep you in the right strategies, get you out of the wrong ones, get you balanced, and really know how to drive your edge, how to navigate your edge. The third metric is yield. Yield is often quoted annually, like the stock market grows about 8% on average each year, so that would be the expected yield. A certain investment might yield 5% through dividend payments, okay? So that 5%, you didn't have to say it, you expect it and understand typically it's quoted annually. But in trading, we can average returns just about any way you can think of. There's tons of ways. You can do the per year like a lot of people do. You can do monthly, weekly, or daily even. very common one is to get the yield per trade. So if you say it's done 800 trades, or it's done 80 trades, or it's done 8 trades, whatever it is, what's the average return on each trade? This is a very important number because it helps you get the understanding of when you put the activity out, what's the average expected return out of it. What's interesting is you rarely will get the average. You normally get something above and below. But if you keep in mind the average, then even when it's below or even negative, you know that you're stacking up that average over time. Even when you just added a negative number to it, you're targeting the average over time. And when you get a big number, you don't get overly confident because you know there's also going to be negatives that average it out. So you don't jump ahead and start trading twice as big because you had a big win, because there's also the downsides. Knowing the average yield is important. Also, what's the average on wins? What's the average on wins? What's the average on losses? So if some strategies have larger losses than they have winners, I don't like those kind of strategies personally. At least I don't want to have a lot of size in them. But you may have a strategy that does that. So when you have a large loss, are you willing to take the next trade because you know that's an average loss, and the next one should be maybe a win, but it won't be as large. But you got to keep moving forward. You got to expect that, know that. What's the average of a long trade versus a short trade? That's buying versus selling short. All right. If you don't understand those terms, don't worry. Okay, that's not the most important part. All right. And yield is simply taking the net return and dividing it by some period or category. The period would be calendar terms, length, years, months, weeks, days, or a category would be the trade, or a winning trade, or a losing trade, or a type of trade, or a trade that's filtered versus not filtered, etc. Okay. We've done studies where a trade after the previous trade was a winner. That was a category of trade. If the previous trade was a winner, the next trade was that category. And so we would average or get the results of only those trades. Then we did another study of trades after losing trades. So if the previous trade was a loss, what's the next trade do on average? What's the returns of those trades alone? So you can know how to expect, what to expect out of those trades. And sometimes even allow the strategy to move forward and wait for it to have a loss to take the next trade. All right, some strategies work very well that way. Like number 2 with returns, if the yield is positive, you have an edge, okay? Because if it's positive, no matter what you divide it by, you should have a positive result. So number 3, yield will also just be a simple definition of edge. Knowing the yield or average return per trade week and month and year helps you compare one edge to another and choose where to put your capital. All right, so here's yet again another great. Let's roll your eyes and say, wow, can you say anything more obvious than that? Okay. Comparing one edge to another because of yield is a very important thing, but here's what's interesting. Soon you'll see why traders focus on really dumb stuff instead of what really matters, like that extremely obvious statement I just said above. Traders will focus on really silly things that make them feel better, that they think are actually really, really important in trading, rather than something so simple as which strategy has a higher yield. You will see a very clear example of that. You may even find that you relate to this more than you were expecting, and I hope this can be one of those big, big turnarounds for you. All right, we'll get to that in a minute though. If your yield from an activity is actively trading, sorry, let me start that again. If your yield from actively trading is lower than you could make by investing, then you should strongly consider if it's worth continuing. I've seen this many times too. Traders work very, 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 very hard, and they're earning 4, 5, 6% a year. And they're spending tremendous amounts in commissions, and they're doing all these things. And you have to decide, am I really moving in the right direction where it's worth doing, or would I be better off getting just the average of holding the market? And there's one reason why a lower yield may actually be more attractive than investing, and that's exactly what we're going to discuss next here in number 4, and that is metric number 4 is volatility. Volatility is another term used to describe several aspects of the markets. It's not a generic term, but it's a term that is used in many different ways. What we're referring to and talking about here is volatility of returns, or the volatility of the value of your account. How much does your account go up and down because of the activity? Okay, so ignore the misspelled word at the end, but pay very careful attention to the following example. All right, so there's going to be some charts, and I want you to really focus in on what I'm sharing with you next, okay? Simple chart, easy, important concept, okay? Two sets of returns. So the theory here is that you start at the left and you end at the right, and you can either follow path 1, which is blue, or path 2, which is orange, okay? And Series 1 earned 160% in this 2-year period. Very cool, right? Well, you can also see that Series 2 ended in the same spot, so it also earned 160% in 2 years, so they are the same. Series 1 had a maximum drawdown of 20%. A maximum drawdown is whatever point, so like right here, and it dropped down. So from here to here is one of the biggest drawdowns, and from here to here is very similar, maybe about the same. So it's 20%. The worst, top to bottom, was 20%. Well, here's something interesting. Series 2 also had a maximum drawdown of 20%, and that's right here. So this dropped from here to here. Okay? So we still start in the one spot, end the other spot, but we have a different path. Series 1 had one large return. It's very interesting because this is the one, it had a massive return early on, and then the average return after that was smaller. And Series 2, however, had more consistent returns. This is one of the most desirable things in trading, is to be more consistent with your returns. All right? The reason why this is so important is because if you missed out, or if you started implementing this edge at number 6, then Series 1 would be well behind Series 2. All right? Series 2, the orange line here, has what we call lower volatility of returns. And what's very interesting about it is its max drawdown, so the max amount it ever lost was the same. The amount it made over time is the same. The volatility was actually to the upside. That it had a very large return concentrated at one time, and then less returns and more frequent drawdowns the rest of the time. So Series 1 has volatile returns, more volatile returns, even though the max drawdown and the overall return was the same. The volatility was less desirable. And here's the very simple way to draw that out, to visualize and understand what we're saying. This third line that's been added connects the beginning point to the end point. And this is a straight line. This is the ideal dream scenario that will never be achieved, but we desire and hope for and aim for to be as much like this as possible. And that is straight line returns. How can we have just consistent up, 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 never down? All right. Well, since we'll never get there, all we can do is get as close to that as we can. And Series 2 much more represents that than Series 1. Although Series 1 has a very large return, and those are very exciting to think about, if it's less consistent, if it's more volatile, then it's typically less desirable. And that would be, by the way, the reason why I would say a lower yield is fine if it's more like a straight line than investing. Investing comes with the risk, the drawdown risk is multiples of what you expect from each year. The amount you could lose in 1 year is multiples of what you expect on average to make in any given year. You just expect to make more money more years. If you can make money more consistently with a fraction of the risk, then that's the time you would expect a lower yield would still be attractive. All right. Number 5, frequency. It's another thing to help you understand about the edge so that you appropriately navigate it and execute it. This is another metric to help you become familiar with your edge, intimately familiar with how it works. The purpose of knowing your frequency is to look for a hidden challenge. This is included in these 7 because it's a very important thing to avoid walking into a losing scenario in the real world. Higher frequency strategies tend to be less reliable for many reasons, but one specific reason that I want to share with you. Why higher frequency is harder? Only so much can happen in a short period of time. This is just a stated fact, a truth about markets and anything, all right? In a certain period of time, a certain amount can happen. When you give it more time, more can happen, all right? The price of an asset is more likely to move farther in 2 weeks than it will in the next 2 minutes. Or if you give it 2 weeks, the amount of movement in the distance that the price can travel is far greater than it can typically move in 2 weeks. There are isolated, very rare exceptions to this where a stock will move in 2 minutes more than it's ever moved in any 2-week period of time. That's the rare exception. Far more often than not, you will see more time allows for more movement. Why is that so important for frequency? Your transaction costs are the same whether you hold for 2 minutes or 2 years. And transaction costs, typically the most important one is slippage and errors. That's the one that is often left out, but I think is very important to always include and assume. Even if you have a fully automated system like many of the systems I run, there are technology errors, there are human errors, there are always errors. And the more often you trade, you have executions, you have slippage, the distance or the actual difference between what you thought the price was and what you got your price at, and any errors that happen during the transaction process. Okay? So if you hold for 2 minutes, and every 2 minutes on average you're taking execution, then you are guaranteeing that same amount of cost for trading, the transaction cost, every 2 minutes that you would have if you only traded every 2 years. And if things can move farther in 2 years, then the relationship between cost and average profit is going to be very different. So, example, if your slippage alone is 2 cents for every round trip trade, and your average profit and loss is 5 cents, then you have extremely tight margin for error, because you have to make at least 3 cents per share to be profitable. All right? Really break even in that scenario. And one tiny little slip up, one bad trade, skipping one winning trade, getting a little bit worse than 2 cents round trip slippage on most of your trades, you will have taken a profitable theoretical edge and turned it into no edge and a loss. But if the slippage is only 2 cents and your average trade is $5 because you're holding it for a significantly longer amount of time, instead of 2 minutes, you're holding 2 weeks on average, you have a larger margin of error. You can make mistakes, you can have lower returns than expected, your slippage could be 5 or 10 cents or 20 cents even, and you'd still have positive results and an edge. All right? Here's an example. This is the theory of taking daily trades in a specific strategy over a number of years, just in theory. All right? And this is if you add where every single trade has 1 cent worse entry and exit price. All right? You probably didn't even notice much of a change other than the title. I'm going to go back so you see. Without 1 cent cost, and now is with 1 cent cost. From about 120,000, a little less than 120,000 to a little less than 115,000 over what appears to be almost 20 years, it looks like. All right, not a big difference. Not a big difference. You could make that 2, 3, 4, 5, 6 cents, and it would still just incrementally bring down the results, but it would not destroy the edge. Here is a 1 minute bar. Okay, so in theory, this is what the returns would be of a certain type of strategy when traded every minute. Every minute. Not that it trades every minute, but that the same signal, instead of analyzing daily data points, is analyzing minutely data points. All right, this is the theory of it. Now, if we use, and this is supposed to say, that's supposed to say hourly, or minute, I'm sorry. So, minute, 1 cent worse per trade. Do you have any guesses? We saw what happened with daily. Let me go back and show you, all right? From here to here, all right? Without the extra cost, with the extra cost. Minor difference. So what do you think the difference is going to be in the 1 minute bar? Is that what you were thinking it was going to be? Quite a bit worse. Adding 1 cent worse per trade completely demolishes and turns this into a loser where you have to squint your eyes to even find a point in time where it's not losing money. Okay? Your margin of error is nothing. Nothing. You add 1 cent. You get 1 cent. So it's a stock price. Say it's $150, and every single trade's $150. When you buy, it's $150 and 1 cent instead of $150. And when you sell, it's $149.99 instead of $150. Okay, so that's 1 cent different every single time. Destroys the trade if you're trading at a high frequency. But if you're trading at a low frequency and you pay $150 and 1 cent, and then you sell it for $154.99 because your trade moved that far, you can be wrong by a penny every single time and still barely impact the results. All right, that's why frequency is so important. Number six, this is duration. Very important for understanding your edge. Okay, another metric to help you truly become intimately familiar with what to expect out of your edge and which ones to stick with and how to navigate them. By the way, you need to understand your edge. A little just reminder of why it's so important to understand your edge. You need to understand your edge so you aren't confused by something that is normal and predictable. You need to understand your edge so you aren't confused by something that is normal and predictable. And actually, after I wrote that, I thought this could be the summary of the entire thing, buried in metric number 6, 40 minutes into this presentation. I've buried in probably the key statement of the entire presentation. You need to understand your edge so you aren't confused by something that is normal and predictable. If you become confused, you will make poor choices because you're dealing with bad information or bad interpretation of information. If you're confused about why you've had multiple losses in a row, when that should be normal and expected, as long as those losses are small and you're just waiting because consolidation is going to break out, you're going to get the big win, you just got to bide your time and wait for it. But in the moment, you're like, is this broken? This is not working. I'm in the wrong market. Everything else seems to be moving. It could be completely normal and expected and part of your edge in a repeatable pattern that if you just went and looked, you'd see it happen dozens of times and resolve itself to very good profits. And you're confused by it and you stop trading it, then you will turn an edge into losses. Duration is how long a trade is held. Simple, right? Why is it so important? Duration of winners and losers is often very different. Often very different. If you just have an idea of the average trade, that's not going to help you navigate wins and losses with the right expectation. Trend following, for example, strategies will exit several losers very quickly and hold a winner for a long time. All right? If you don't understand that, you will be frustrated by losers and impatient with winners. If you don't understand that trend following strategies are going to cut loss, and just wait and wait and wait and wait. And when the big win comes, you just sit back and ride. If you don't truly understand that with numbers and statistics about how often they happen and how long they typically last, then you will be confused by whipsaw and you will be impatient through a trend. You'll be saying, I'm just so used to these trades that only last a day and a half or 3 hours or a week that are losses and things turn around. I've seen this thing turn around so many times and this trade's working. It's the biggest win I've been sitting on and I really should just take this thing. I should just at least cut half the trade. I should take this trade off. And you don't understand that the duration of wins is multiples of the duration of losses and that the size of wins is multiples of the size of losses. And the only way you'll have an edge is if you let that work. Then you'll break your edge. You'll have an edge but losses. Okay? Here's an example. So the first trade here, by the way, if you're not familiar with this, the buy, so it says buy, and here is short, actually it's just selling. It says short, but all it is a sell. So this is the starting point of the trade. This is the ending point. If it's this bluish green colored line, that's a profitable trade. You bought here and you sold here. So you have a win. Okay? So you're happy. The next one is you buy here and then you sell down here and you're not happy, right? Okay, that's fine. So then you get into another trade, you buy and then it sells here. And so, okay, that didn't work. And so you try again and then you buy here and you sell here and it didn't work. And then you buy here and you sell here and it didn't work. And then you buy here and you sell here and it didn't work. So at some point you're like, all right, I guess I just picked the wrong strategy. This just isn't working. This stock isn't working. Maybe there's some other stocks I can use. Maybe there's a different market I can use. Maybe there's a different indicator I can use. Maybe there's a different time frame I can use. I really don't like all these losses. I thought this was supposed to be something where I'd make money. I'd be consistent. All right. This is not being consistent. I don't like this. So if you don't understand it, if you don't have a knowledge about the duration of trades and the frequency of trades, the frequency of losers and the duration of losers, and the average return, and finding examples of how all this stuff works, then at some point you'll just become frustrated enough that you'll quit and you'll stop and you'll go on to the next shiny thing where it looks like people are just making money every day and you've just been missing out, and you'll just go switch over to that one now. And what will happen next though? So now we've zoomed out and we've seen what happens next. So you started off happy, and then you got sad, and then you got angry, and then you just gave up. You walked into what should have been expected. You walk into the trend move that you were trying to trade for. And you see the duration there, very important. Look at this. You see all those losses, right? All those losses are maybe, I'm just visually looking at this, I'm going to be generous and say a little over a third of the chart. A third of the chart, let's say. So a third of the time you had losing trades. At the beginning you had a win, at the end you had a giant win. That means 2/3 of the time you were in winners. 2/3 of the time you were in winners. But you went through multiple small trades. If you actually look at the rate, you had 2 winners and 1, 2, 3, 4, 5, 6 losses. 6 losses, 2 winners. That's not fun. But if you look at the time, this is a time chart. Okay, the x-axis, left to right, is time. You spend most of your time winning, even though only 2 trades won and 6 trades lost. If you don't understand duration and the fact that all those little losses were exactly what you should have expected with this strategy, quick, small losses. I will be in when it's time. If I stick with it, if I understand it, if I know it, you would be in that last one. Or maybe you're going to find out after the fact that you missed out because you didn't understand the duration of wins and losses in average trades. Metric number 7. All right. So before I reveal to you metric number 7, also after this, I'm going to give you the printouts, and you'll be able to get those and save all this information. But I want to tell you about number 7 before I share it with you. Kind of share some characteristics of it because it's a very important one. And it's very important for the reason I have it included is because it's important, but it's not important at all for the reason most people think it is. And it's the last one, number 7. It's the last one listed in the metrics, barely makes it on the list, honestly, where most people put it at number 1. It's the biggest distraction in trading. That's my absolute conviction of an opinion, that this is the biggest distraction in trading that gets people to make really dumb decisions, like I mentioned earlier. We're going to look at that here. Almost as bad as trying to predict what will happen next. All right? Because I think most traders know they shouldn't be predicting. They shouldn't be forecasting, and they kind of know it's not the most effective way to do it, so they kind of know that. But they think that this one, number 7, is actually important. And so they focus very, very much on it. And it is one of the leading causes of not just independent individual traders, but of hedge funds to blow up. All right, that's my opinion and observation over many years now and looking back into history, that the overemphasis of our metric number 7 is what leads people to catastrophic failure in their trading. But it's still listed, not because I just want to bring up how bad of an idea it is to focus on it too much. It's still listed because you should know it, but for other reasons. Okay, so it is still very important to know, but not as important or not for the reasons we expect. And number 7 is win rate, also called accuracy, but win rate is that really exciting idea. Okay, Have you ever been attracted to the idea of having a 90 or 95% win rate? If you do 100 trades, only 10 of them lose. If you do 100 trades, 95 of them are going to be winners. Over the next 100 days of trading, 95 of them will be profitable. Have you ever just sat back and daydreamed about that? Maybe even dreamed in your sleep about being right in trading 95% of the time? Have you had dreams of even being 99, or the completely unrealistic but just really fun to think about, 100%? Can you imagine? Could you imagine? 100% of the time you are right. Isn't that incredible? Isn't that something to aspire to? It's not that important. I'm dead serious. It's not that important. And even if you had a 99% win rate, I probably wouldn't even want to know what you do. That's how unimportant it is. I actually think you're in for trouble at a 99% win rate. Let me show you this. Which graph do you want the growth of your account to look like? This should not be a hard question. Okay? If this was a statement of your account, which one of these would you want to visually represent the level and growth and profits of your account? The one that goes up and barely ever goes down, or the one that goes up and down a lot, and up and down, and then finally up again, and then up and down? Okay? So which one? Are you sure? Are you sure that you would want the one that would just over time just kind of appear to go nowhere but up? Are you really sure? You don't want this one here that comes down a lot every once in a while? All right, you asked for it. All right, if you want to know which of these, or what it takes, what the path of the top chart looks like, then I will now explain to you the win rate of each of these trades. The strategy used at the top has a 39% win rate. Now in school, if you get a 39% on a test, we call that failing, right? They may not, if you get a 39% on your report card for one of your classes or the whole grade, you don't get to go on to the next grade. You're a failure and you do not get to proceed to the next level. Well, I look at this and see a 39% accuracy, a 39% win rate, a 39% of trades being quote unquote right, and I see a lot of good progress. I see something I want. Down at the bottom, what we have here is a 71% win rate. And depending on what school you go to or where you live, where I went to school, I guess that's just about anywhere that's passing. All right, so I've seen some schools where you got to be in the 50s before you're actually failing. One place I went to school, 69 was failing. Actually, we'd be a failing grade. You get an F. But 71, you do pass. You're passing here. Okay, it's much higher win rate. But it doesn't feel like it, does it? It doesn't look like it. All right, what happens here is trades 2 through 6 here are losses, then a win, and then trades 7 through 10 here are losses, and then a win. And 2 wins in a row. Look at that. And then a loss, and the win. That's good. And then 2, 3 in a row. And then here we just end pretty much everything except for 1 here are losses. Okay. What do we have here? Look at this. Win, loss, win. You see that? And then pretty much mixed bag, maybe 50-50. And then look at this. Win, loss. Win. Barely see that one pop up. Loss again. Break even. Oh, there we go. Win. Do you see how that works? And look at this series here from 40 to about late 50s here. Almost all wins. Incredible, right? Well, what I see here is, yeah, there might be 15 wins there, but that actually made less money than this one win right here. One of them. Okay? Now let's go through. This is going to be an example to kind of wrap this idea up before I show you how to get the printout of these slides. We're going to go now and look at these two examples, and I'm going to explain to you, number one, the 7 metrics. We're going to go top to bottom through the 7 metrics to see why they are in the order that they're in and why we focus on these 7 metrics. All right? So the returns of number 1 are better. The risk of every single trade, the absolute risk, is exactly the same. All right, so you maybe not in green, that could be like gray or something. So they're the same. The yield is higher. We used the same amount of money, and the 39%, 31, whatever it was, 39% win rate made $450,000. The other one with the same amount of capital applied only made $110,000. So the yield is higher. The volatility is lower. Okay, there's less ups and downs, just more smooth. You draw a straight line from one to the next, it's going to be closer to a straight line. It has that where it's just continually rising and rising and rising in a very consistent pattern. It's not all concentrated into one area. The frequency is lower. I would actually debate putting that in green. That over the same period of time, which this is, over the same period of time you execute fewer trades, which means your slippage and risk is, or not slippage, but your transaction cost is going to be less of an impact, less of a factor. So where maybe risk should have been black, frequency would be green. Lower frequency to me is better. And the duration is longer. That's very related to frequency, that the holds are longer, but it's just a piece of information we need to know, that when that wind comes along, you may be sitting on it for a long time. And so you need to know, and it's okay if you walk through trades 2 through 6 as losses, because those may all be concentrated in a couple of days. And trade number 7, where you go from 6 to 7, there's a big win, that may last 2 weeks. Where these are just, we don't have a visual representation of time here. This is not a time chart. This is just listing out returns and graphing them that way. But knowing the duration, that each of the trades is longer and the wins are significantly longer than the losses, is an important factor to know and understand. It doesn't define if I have an edge or not, but it's something I need to understand so that I continue to trade after trades 2, 3, 4, and 5 lose. But the one thing that's worse, if you could say it even matters, is the win rate. It's the win rate. Now, it's important to understand because that's one of those things that's going to allow you to make it through multiple whipsaw losses if you have a low win rate, or if you have a super high win rate, that you shouldn't become overly confident having 6, 7, 8, 9 winning trades in a row and start doubling and tripling your size because you think it's never going to lose again. If you know your win rate and you know the average size of your losses and you know the duration of losses and the frequency of losses, if you know those things, then you won't get overconfident, oversize, and get number 1 wrong. Which, by the way, I got numbers 1 and 2 flipped there. I'm supposed to do the opposite, risk first. You would have your risk wrong because you would be increasing risk because you don't understand the rest of your edge, and you would walk into a big problem. All right? So I hope this has been helpful for you. If one of these across the left side has really stood out to you as a new concept, an important concept, one that you haven't understood before, then I ask you to really take that, write it down, journal about it, and meditate on it and think about how you can apply it to your trading to start having better results. Okay? So what I want to do now is tell you how to get these slides completely free. Normally I would take, even if the presentation is free, you know, the recording or the slides might be something you would pay for, but I just want to give these to you for free because I think this is foundational and very important stuff. So what you do is you go to edgenavigator.com/7, and that's for the 7 metrics. All right, that's the word 7 spelled out, should be all lowercase, edgenavigator.com/7. So go there and get these slides. Print them out, save them, whatever you like to do. Also, if there's a contact form you can easily get to and you'd like to get some feedback, or if there's a comment area next to this video, please share your thoughts in response to this and what you found to be interesting, and any questions you have. I'd be happy to answer those. All right, so thanks for watching this. Go grab those slides right now, and I look forward to talking to you in a future video. See you later.